The S&P 500 dropped 2.7% last Friday. And even though this seems like a large drop, if you zoom out on the chart, it's actually a very minor dip in the history of the S&P 500. And then on Monday, after Trump tweeted everything's okay, the market gained back a lot of what it lost on Friday. The VIX shot up 40%, and there was major liquidations in Bitcoin and other cryptos, and a lot of stocks as well. So what does this mean about your money and your portfolio, and what stocks should you be looking at right now? So in this video, I want to go through some of the stocks I bought, and also how to find certain undervalued stocks. What should you look for as an investor? So with that, let's get started. The first stock I bought was HCC, Warrior Met Coal. And if you follow this channel and watched any of my other videos, you know that Warrior Met Coal is one of my favorite plays, and I'm trying to get a really concentrated position here. The reason I bought, even though I'm up 50% roughly on this position, is that I think it's still undervalued. There is so much going for this name. It is the lowest cost met coal producer, or one of the lowest in the world, and definitely one of the lowest in the United States. On that cost curve, it is incredibly important for miners to maintain a very cost-effective structure so that they don't overextend themselves in downturns like these. So met coal is in a cyclical downturn right now, and the met coal prices are depressed. It will trough at some point during this year or early next year, and then those met coal prices will start to go up as steel demand starts to improve. So that's the thesis number one for Warrior Met Coal. Thesis number two is they are almost finished their Blue Creek mine, scheduled on time and at budget, not over budget, and that's going to be completed sometime in 2026. And once that is complete, their CapEx for this growth project will be over. And the most important thing is that they're going to ramp up production of met coal to close to 14 million short tons per year. And this puts them on par with AMR, which is the largest domestic met coal producer in the United States. They produce about 17 million short tons. This will make them have 3 very good mines that are producing met coal, and that increase in production will increase their revenues, obviously. And that, in a conjunction with the reduction in CapEx for that build out, will explode their free cash flows relative to their revenues and relative to their market cap. Now here you can see in their investor presentation, I've showed this before, but here are their mines. They have Mine 7, Blue Creek, and Mine 4. And in recent news, Warrior Met Coal was the highest bidder in the Fed land auctions for opening up mining for met coal in those lands. They spent about $46 million to win that bid, and that is proposed to have 53 million tons of met coal across 14,050 acres. That comes out to billions and billions of dollars of revenue potentially over the course of many years for Warrior Met Coal. And the risk to reward is they spent 46 million and they will pay royalties to the government, but the risk reward will be immense for Warrior Met Coal decades into the future. So this only enhances the investor prospect for Warrior Met Coal. If they are able to generate $250 to $300 million without Blue Creek right now in free cash, then they are able to produce maybe double that or a little bit more than double that with Blue Creek year in, year out. So going forward in 2027, when everything is fully ramped up and fully in production, we could see a perfect storm of events coming together for this name, and we could see this price action being multiples of what it is right now. Another company that I have been buying in this downturn is Amazon. Amazon is an amazing company. It's a conglomerate of so many different business segments and revenue generating segments that it is hard to miss with Amazon. If we look at their chart, you can see that it's been going down over, many days. It's been coming down over many months, and I think this represents a great buying opportunity for this name. And it posts enormous revenues from its e-commerce business and its cloud business and several other businesses. Revenues from their latest quarterly report, you can see that they are up and to the right for the most part. Their net sales are going up. They reported $670 billion of revenue. They're on track to hit 1 trillion in the next 5, 10, 15 years, I truly believe. And you can see that they've segmented their revenues, their net sales. They have AWS as 18%. They have international sales at 22%, and the majority of their sales, 60%, comes from North America. Operating income is $19.17 billion in Q2 2025. Operating income trailing 12 month is $76.19 billion. Net income came in at $18.16 billion. So net sales from AWS, which is their cloud segment, which is really important to look at, is going up and to the right. It's $30.87 billion for Q2 2025. And operating income from AWS was $10.16 billion in Q2 2025. All in all, trailing 12-month net sales was $116 billion. Trailing 12-month operating income was $42.8 billion. Free cash flow, and this is what is part of my thesis on Amazon, is their free cash flow keeps going down because they keep reinvesting so much back into their business. So this is not indicative of bad business performance. In fact, it's quite the opposite, actually. It's representing how much they are reinvesting into their business. Their long-term goal here is to optimize free cash flows. Free cash flow is cash flow from operations reduced by purchases of property and equipment, net of proceeds from sales and incentives. Operating cash flow increased 12% year over year. So really what's happening is their operating cash flow is going up while they are spending more than that, on more than 12% year over year on the purchases of property and equipment, which is reinvestment into their company. If they, for some reason, tone down this reinvestment into their business and somehow want to capture more free cash flows, they can. They just need to reduce the purchases of property equipment, of CapEx, and they could tune up their free cash flows whenever they want. And when they do that, the value proposition for Amazon changes completely. If you do a DCF model on Amazon with increasing cash flows or higher cash flows, it increases the value of the company immensely. Their shares have been pretty much steady. They do share buybacks, but it's not anything crazy. They do stock-based compensation, so it kind of offsets what their share count is. But again, if they change their CapEx, if they reduce their spending on that, they have so much more capital to do share buybacks, to even issue dividends at some point in the future with a reduction in their CapEx. Long-term goal, efficiently managing dilution. So what they do is basically buy back enough shares to manage the stock-based compensation. Look at their press center. You can see all the different business types and new business types that Amazon is getting into. Look at, for example, here they're saying Amazon Pharmacy launches in-office kiosks to help patients get medicines. So basically this is disrupting so many other businesses, and Amazon is able to do this because they have such power and scale. AWS selects 40 promising AI startups from around the world for a generative AI accelerator. The NBA and AWS announced new multi-year partnership to power the next era of basketball innovation. So their hands are in all of these different pots. And that is part of their CapEx and reinvestment into their business. They're spending a lot of money to get into all of these different businesses. But if they ever tone that down, again, this would be an enormous free cash flow opportunity here. Not to mention their Zoox platform for autonomous driving, their quantum computing chips that they recently addressed. You see how all of these quantum computing chip stocks have risen dramatically over the past year. So they are in all the right spots to benefit from all the new technologies, all the new disruptions that they can make in the market. And here is a video that I did a few weeks ago on this channel about Amazon, their valuation, their moat, and just in-depth analysis of this company. The last stock that I added to in this minor downturn is Nike stock. And Nike is very interesting because it's a quality company, been here for years and years and years, produces revenues, has been combating competition in the recent years, but I think we'll be able to figure that out. And they recently showed a fair value gap that I've pointed out on X, if you want to follow me there, and on YouTube. And it has been filling that up pretty well. It hasn't reached the bottom, but it got more than 50% of this gap fill filled. So I've started DCAing into this even more, and I've added some more shares in the public account. But my thesis around this company stays the same. I think it's a double, triple in the next few years as they figure out how to combat their increasing competition. And they're still major partners for all of these leagues and events, sport events. So they're part of the NFL, they're part of the NBA, they're part of the World Cup that's coming up in 2026. So they're major events where they're going to be seen, and their logo, their name, their brand will get out and be seen. Elliott Hill has come back as the CEO, and he is a veteran in the Nike space. So he knows what to do and how to move Nike forward from its recent missteps in the past few years. And that in the numbers, their first quarter revenues were 11.7 billion, up 1% on a reported basis compared to prior year, and down 1% on a currency neutral basis. Nike direct revenues were 4.5 billion, down 4% on a reported basis, but they're trying to right size this ship. So it's taking a little bit of time. Wholesale revenues were 6.8 billion, up 7% on a reported basis. Gross margins decreased 320 basis points to 42.2%. That's still a pretty high gross margin in this type of space. Diluted earnings were 49 cents. One thing he points out is, I'm encouraged by the momentum we generated in this quarter, but progress will not be linear as dimensions of our business recover on different timelines. So he already knows how all of these business segments work, and he is optimizing those, and he's level setting with investors that each business segment will go at its own pace. I want to mention with all three of these companies that I've bought in this recent downturn is they are growth companies, they are dividend companies, and they are value companies. So this is what I'm trying to get. I'm trying to find the best companies that can provide growth, appreciation, which means appreciation. They see some type of growth, whether it's through acquisitions or through building out a project to grow revenues in the future, or they are changing their dynamics, introducing new product lines, or introducing new initiatives to supercharge growth. And dividends are important, but they're not as important as the other two. But I also include share buybacks in this category because share buybacks are a very direct and flexible way to return capital to investors. So either look for dividends or share buybacks or both. And a lot of these companies are definitely going to either have share buybacks or increase their dividends or do both. And then also there is value. So are these stocks, are these companies undervalued or overvalued? When you buy these companies, if you buy it at $1,000 per share and it's only worth $500 per share, you're not getting good value. And it's still, even if it's a great company, you're not getting a good deal. You have to make sure that you're getting it at the right price. Good company at the wrong price is still a bad investment. Those three factors are the same in all three of these names that I picked out in this downturn. So that's what you need to be looking for. You need to look for growth, you need to look for value, and you need to look for dividends or capital returns, basically. You also come back from share buybacks. So that's it, guys. Thank you for sticking with me with this shortish video. If you like this content, please like and subscribe. And if you want to know more of the stocks that I'm buying, there's other stocks that I bought. Please follow me on Patreon, and then you'll see all my stock buys and sells, even options that I've done, and it's all neatly written out. And you can see my reasoning as well behind all of those moves. So if you like that, please follow me there. And with that, I'll see you guys in the next one.